Is a recession on the horizon? If it is, are your retirement savings at risk? Recession is never something that anyone wants to talk about, let alone face, but it's a nearly inevitable consequence of our economic system. Everyone loves the boom phase, but when it comes to the bust phase, well, no thank you. But what if there were still opportunities to make money even during that bust phase? Many people turn to gold during a recession, given gold's reputation as a safe haven asset and a store of wealth. But is gold really a good investment during a recession? Well, you're about to find out. Plus, if you stay all the way to the end, there'll be a special offer for you that you don't want to miss. Recessions in the United States are officially defined by the National Bureau of Economic Research, or NBER. So while the economy may look and feel sluggish, it isn't until the NBER has officially declared a recession that a recession is deemed to have occurred. Unofficially, a recession is usually defined as 2 consecutive quarters of negative economic growth, with economic growth normally being defined as gross domestic product, or GDP. But that isn't an exclusive definition. The recession of 2020, for instance, was a result of only 2 months of negative growth. The shock and severity of that recession was so great that even though it didn't last for 2 quarters, it was still defined as a recession. Here are a few of the factors the NBER and other analysts use to determine whether a recession is occurring or not. 1. Unemployment. One of the strongest indicators of a recession is rising unemployment. During recessions, unemployment tends to rise, and sometimes significantly. That's because recessions result in numerous companies going out of business or downsizing their operations as a result of falling consumer consumption. As a result, these companies lay off their employees either due to bankruptcy or because they need to reduce their costs. During the Great Depression, unemployment peaked at 24.9%. During the 2008 financial crisis, it was nearly 10.3%, and during the 2020 recession, it was nearly 15%. 2. Economic slowdown. With the traditional understanding of recession being defined as 2 consecutive quarters of negative economic growth, it's clear that the overall definition of recession will be defined by economic growth. Assume a scenario in which unemployment was increasing, but in which economic growth was increasing by 5% a year. Would anyone classify that as a recession? Well, probably not. One of the key aspects of economic growth to keep in mind is that economic growth is most often defined in terms of GDP. GDP includes government spending as one of its components. So even an economy in which business activity is decreasing could theoretically still have rising GDP as a result of an increase in government spending that outpaces the decrease in business activity. You could say that it's a sneaky little trick to make Americans think everything is A-OK. While the initial months of recession may be too subtle for many people to notice, normally recessions become pretty easy to notice once they're underway. Consumer spending may decrease, industrial production may drop, and various other factors will indicate that the economy is contracting. 3. Inflation. Inflation isn't necessarily a factor that accompanies all recessions, but it can accompany recessions and it can exacerbate their harmful effects. After all, if you've just lost your job and the things you need to buy are getting more expensive, life is going to be pretty miserable for you. The United States has not experienced recession and severe inflation together since the stagflation of the 1970s and the severe inflation of the early 1980s. The 1970s were a decade that many investors would rather have forgotten as stock markets went nowhere while inflation reached double digits. The recession of the early 1980s featured severe inflation as well, with mortgage rates reaching nearly 19%. We have not experienced rates nearly that high today, but the Federal Reserve hasn't yet finished its rate hike cycle, so there's no telling how high interest rates might reach. Inflation appears to be under control right now, but if the Fed ends up returning to monetary easing to react to a recession, inflation could once again start climbing. And that might be a tough situation for everyone, but just wait until you hear about gold's performance during recessions of the past. Some of these impressive numbers will shock you. But first, let's talk about how markets usually perform during recessions. And I'll give you a little hint, it's not pretty. Investors don't like to see recessions because it normally means that the value of their investments will decrease. That's particularly true for stocks, which can suffer major losses during recessions. During the Great Depression, for instance, stock markets fell nearly 90%, and during the 2008 financial crisis, stock markets lost nearly 55% of their value. It's no wonder that investors fearing a recession look for stores of value and safe haven assets to protect themselves during the recession. Well, you can certainly recoup your losses given enough time. Not everyone has years and years to try to win back the losses they suffer during a recession. Now for the good stuff. Just wait until you see gold's performance. Gold has a reputation as a counter-cyclical asset, one that does well during recessions even when markets are collapsing. Its performance during numerous recessions and financial crises certainly bears that out. During the 1970s stagflation, for instance, gold made annualized gains of over 30% per year over the course of the decade. While a 30% annual gain is great growth for any asset, to make that kind of average growth over the course of a decade is pretty phenomenal. Most investors would be pleased to make even half that rate of growth over a long period of time. Gold once again made great gains during the 2008 financial crisis and its aftermath. While gold did see some periods of decline in 2008, overall it gained 25% in the same period that stock markets lost over 50%, from October 2007 to March 2009. The gold price went on to set an all-time high in 2011 as gold remained a shining bright spot during a period in which many assets seemed to be floundering. Ultimately, the decision about whether or not gold is a good investment for you is one that you'll have to make after taking into account your unique financial situation and financial goals. But many thousands of Americans have already taken the opportunity to buy gold to help protect their finances. Some of them see gold as a safe haven asset and a store of wealth that can help them protect their wealth during periods of crisis. Others see gold as a hedge against inflation, an asset that can help them maintain their wealth when the dollar and other currencies are being devalued. Some just like to diversify their holdings just in case. The top-rated precious metals company, Goldco, has helped thousands of satisfied customers protect themselves over the years, making over $2 billion in precious metals placements. With direct relationships with mints around the world, they work hard to bring their customers gold coins and gold bars that are guaranteed to be authentic. And their customers' 5-star reviews are a testament to their dedication to quality products and customer service. If you're looking to protect your hard-earned savings with gold ahead of a recession, it's important to work with partners you can trust. Right now, Goldco is offering a free Gold IRA kit to give you nothing but the facts when it comes to buying gold and performing a Gold IRA rollover. Trust me, you'll want to get your hands on this. To get your free Gold IRA kit today, simply click on the link below or give Goldco a call. We'll see you next time.